Eric, we are back with the AI Investor Podcast, and the rumors of our death were greatly exaggerated. Thank you to our many dozens of listeners who wrote in concerned about our health and well-being. We know it's been a while since you've heard from us, but we are back, and we are starting here in some choppy waters, so to speak. Markets have been all over the place. Nasdaq has been selling off pretty hard the last 2 weeks. And if I sort of chart maybe the narrative or vibe shift and track it to our own episodes here, I think it was early August, you and I said, hey, this is the first we're maybe starting to hear a little bit, maybe not some chill entering the conversation, but some neutrality, right? Some people who were previously bullish, maybe getting a little neutral. And then since then, it's been like a little bit of the curve has been accelerating. Maybe there was some negativity in September, October, turning into full on bearishness. It's not like we're in a bear market here by any means, but some of the stocks have sold off pretty sharply. So I wanted to make sure we talked about that and we discussed what was going on with the portfolio. But Eric, it has been a while. So how about you? Anything you want to share with the listeners here before we jump back in?
Yeah, not dead, maybe in a coma for a bit, but people can see in the background if you're watching on YouTube. It's not quite a Motel 6, but I think slightly above that. So I'm traveling from the road, very, very close to where Taiwan Semiconductors building their facilities in Arizona today. But Austin, the big thing is just we want to give the best possible guidance on this podcast. We run our own business, trying to grapple with how to create a company that's going to be resilient in the age of AI, and that's a huge challenge to undertake. We also do consulting work. I've been on a major project. Next week, I'm flying to Abilene, Texas, to go visit Stargate and some of the biggest data centers and see them firsthand. So I've been traveling. I've been putting together a ton of research, and we want to host this podcast today because the market is kind of at a pivotal moment today, and we don't want people who have been following both the AI space and also the AI portfolio to not hear from us at a time like this, because I know when stocks are suddenly in free fall, fear is dramatically rising in the market, that can be difficult for investors to navigate. So we did want to give everyone, that 10,000 foot lay of the land and discuss kind of how this is impacting some of the stocks in the AI space.
Eric, well, thank you for that. And you and I were discussing before the episode, we are going to try and be crisp and judicious here because you are on a tight schedule. You are traveling from, all across the United States looking at data centers and AI projects. I just wanted to throw one quick thing in before we jump into the news and what's going on with the market, which is if we're going a couple of weeks or longer in between episodes and you're looking for other resources out there to make sense of the markets and pick up some great stock picks, you and I always are happy to recommend the Motley Fool. It's a fantastic company with a lot of wonderful services. They've taught us and me personally a lot about investing, and many of the principles that you and I learned at the Motley Fool we apply in this portfolio and our work every day. So if you're looking for more investing content and you haven't heard from the AI Investor Podcast in a while, check out the Motley Fool and some of their fantastic services out there. Really wonderful analysts and just great principles for building wealth. With that said, let's jump into the market. There's so much going on. I mean, I was going through my own notes since our last episode, and I know we're going to talk about this at the end. This feels like it's OpenAI or nothing. And we talked a little bit about OpenAI being like the tentpole of the AI industry. So we'll talk about that in a minute, but there's a sell-off going on, and the last time we had a sell-off was DeepSeek. Now, DeepSeek was sharper. It was more acute than this. This is not as severe. It's a little more progressive, but this is a sell-off. Let's call it what it is. So what are you seeing out there, right? Your average picks, some of the market performance, what's going on?
Yeah, so you bring up DeepSeek. If we did a DeepSeek scale that we were going to track, we'll see if this is continuing or by the time we do a next episode, we have sailed on. On a scale of 1 to DeepSeek, I would put this at like 3 out of 10 right now. It is a sell-off, but in DeepSeek, we not only had DeepSeek, but then we had a lot of concerns about Microsoft walking away from data centers, which has been explained in time. And at the time, we also refuted that very strongly, which was correct. And then we had kind of the tariff and geopolitical concerns, which all kind of coalesced into a much larger sell-off than we're seeing today. But what we are seeing, the portfolio, the average recommendation was up 70% within the last week or two. When I looked this morning, the average recommendation was up 53%. Now, the NASDAQ is only down about 5% from its peak. But Austin, what we're seeing is very clear. What I always do, any day the market is down more than 1%, the first thing I Google is S&P sector performance. And I look how factors align. to try and understand what the market is doing that day. So if I see technology stocks down 1.7% and healthcare up 0.5%, it's very clear that's a rotation out of risk.
Right.
And that's what we've been seeing a lot of days recently. We've been seeing the Dow might be down 0.6%, NASDAQ's down 2%. People are trying actively to get out of risk. Now, I'll note it's been the pain is not equally felt, Austin. A lot of stocks with large retail followings, with a lot of momentum recently behind them, have hit the worst. Strategy, we talked about one of our concerns earlier this year. Strategy was trading for, I believe, 3 times its net asset value. So the amount of Bitcoins they owned, they were trading for 3 times that value. I believe they're now trading below net asset value, and they're down 54%. Quantum stocks, the most speculative of quantum stocks, are down about Rigetti. Let's look. I wrote it down. That one's down 55%.
Yeah.
Yeah, in the past month. Iron, the kind of leading YOLO play, I would call it, in the neo cloud space. That one's down 36% in 6 trading days.
We need a couple different metrics here. We've got like on a scale from 0 to DeepSeek. I also want a scale of 0 to IREN on the YOLO meter, right? we need a couple different enthusiasm meters here. 0 to quantum on the pure YOLO speculation meter.
All right. Well, Palantir, a company that 0 to IREN is probably about a 5. We've talked about that. That one's down 17% in the past 10 days. So, Austin, there is, and I'm not saying all these companies are junk. Like, Palantir is a wonderful company. It's just a question of valuation. But these popular shorts, they're getting sold off ruthlessly. Things with a lot of retail buying are getting sold off. Some of this is healthy, but the question is this indiscriminate or not? Are stocks that have high quality getting sold off with this? If so, you have a lot of long-term opportunity. I believe we're in that zone right now. But, Austin, like you said, we want to stay crisp. That's not my nature. So, maybe we should dig into some details as well. So I would be curious from you, as someone watching this, what have you thought recently about some of the storylines driving down the market, like OpenAI and some of the storylines around them becoming a systemic risk? How do you see that as kind of a broad investor?
Yeah, I mentioned this. I don't know if it was in our last episode or the episode prior. I continue to remain very bullish and optimistic on the potential of AI. I think the biggest analogy is the internet, and that analogy continues to hold true through this whole cycle, right? Where there's junk companies that get bid up, and there's quality companies that sell off, and you have to try and separate the wheat from the chaff. One of the things that I am uncomfortable with in this environment is how singularly important OpenAI and Sam Altman have become, right? It seems so much of the money that's circulating is dependent on OpenAI buying compute, building compute, selling money. This is a company that I think Sam had said what their forecast, they're going to exit this year at a 20 billion revenue run rate, but they're committed to somewhere close to $1 trillion of CapEx. That's a tough gap to close. It's some of Earth's most impressive technology, and they're Earth's most impressive company right now. So I'm very optimistic on the potential of AI. I'm just a little concerned on let's call it concentration risk. Risk on one company that's private, where we don't get to see their financials, and one CEO who is obviously unbelievably talented and a fantastic deal maker, but also contentious. You and I were sort of like marveling at the fact two and a half years ago, Sam Altman was ousted at OpenAI as CEO. So I'm a little concerned about that concentration risk, but I'm still very optimistic on the technology, to repeat the point. But I'm excited to go shopping now. This feels to me like a moment where I'm going to start buying a couple more AI plays on the sell-off here. Let's talk about some of the companies that are down that you think are most interesting, right? As there's this rotation from YOLO, out of some heavily speculative YOLO stocks. I'm probably not going in on quantum. That's probably not where I'm going to put my money. But are there sectors where you would see like, maybe the chip makers or the cooling companies are getting sold off harder than you think they deserve right now?
Yeah, and to put a fine point on the reasons why I believe this sell-off is happening, just to give context to listeners. One, I believe it's a lot of market concerns about OpenAI. Yeah. We could probably have Brad, our producer, play a clip in a second, but Sam Altman had appeared on the BG2 podcast, which is from a couple of venture capitalists, and Brad Gerstner had asked him a very, like, the kind of question that if you're in PR 101, you're expecting, which is,
how can a company with 13 billion in revenues make 1.4 trillion of spend commitments?
Altman, his reaction was almost indignant, like, I'm above having to answer this question. And it's like, no, that is the one question you need a solid answer on, right?
And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just, enough.
And I'll say he's talking to a friendly investor. I believe Brad is an investor in OpenAI, and Sam sort of had this quip of, well, I'll find someone to buy your shares. Instead of answering the question, was sort of like, how could you be bearish on us? That rubbed me the wrong way too. I'll give you another deep cut, interesting one. One of my favorite podcasters is Tyler Cowen, and he does conversations with Tyler. I don't know if I shared this episode with you, but he also interviewed Sam Altman. I think the episode dropped within a week of the BG2 one. One of the things it was just ironic, and I'm not saying that this is bearish for the AI sector. He kept asking Sam these questions about, how do you leverage yourself? How are you achieving this growth? And you expect Sam to say, oh, I'm using GPT every day. And he kept saying, well, we hire really great people. And Tyler Cowen even asked, like, when you're going in to learn about these new markets where you're doing deals, in Saudi Arabia or Arizona or wherever, how do you develop the local expertise? So if I said, oh, well, we hire a lot of local experts. And Tyler said, well, why not use AI for that? And Sam sort of said, well, there's some like subtlety and nuance that we can only get from experts, which I thought was very interesting out of the guy who is, in many ways, has to sell the most bullish version of what AI is, sort of admitting that there's still some really important use cases where it's not there yet. That's not bearish for the technology. I think it's just an interesting commentary on where it is today. And he even said in that conversation with Tyler, like, they had a hypothetical, how long until we have an AI CEO? And you sort of could hear, well, like, maybe that's not really realistic for a couple reasons. So I just thought that dichotomy was interesting. You have to be out there selling the edge potential of AI, while also maybe admitting internally that in your own operations, you're not ready to, it's not quite ready for prime time to fully replace those skills. But hey, let's move on a little bit. You talked about what spooked the market. What are, and we talked about how OpenAI has become this single tent pillar. What are some of the other areas creating noise, right? So there's like the Fed comments that came out recently about now the odds of a rate cut are now less than 50%, where it did seem inevitable. I think at one point they were close to like 60 or 70% we were going to get another rate cut. There's also perma bear Michael Burry coming out with a short. Now, ironically, quickly closing that short, but like it's not just Sam Altman and OpenAI. There's some other sort of contributing accelerant. What else are you seeing out there?
Yeah, and so OpenAI, they had made a comment about wanting a federal backstop. It was a little bit of a misquote from the CFO to WSJ, but it has sparked this cycle where there is a lot of discussion. As we've talked about in recent episodes, we are moving from AI being cash flow funded to debt funded. And if the debt markets start moving in a big way, it introduces a lot of additional risk. So we had, yes, the Fed. Right now, I believe in prediction markets, the odds of a rate cut are down below 49%. A lot of the macro environment and overall market valuation has been kind of rising because of the expectation that rates would fall and lead to kind of additional economic activity with, the downsides of inflation. That appears to be tamped down a bit right now. So that's an overall thing. But number two, Burry, Michael Burry, he had made a big case that these companies were going to be overstating earnings because of how they, handled depreciation. Yeah. So again, it just creates this cycle that now you are seeing it in very tangible areas, and we'll talk a bit more about this later, but you are watching. Burry famously made all of his money from credit default swaps on parts of the U.S. housing market, and we are seeing a vast rise for this market in credit default swaps around companies like Oracle, companies around like the Neo Clouds, Applied Digital type companies, that the market is increasingly building in expectations they are not going to be able to make good on these deals. And that's what's sparking the fear as well. So what is this current DeepSeek moment? It's a general kind of backing off AI because of a disbelief among the money manager crowd about things like Sam Altman, and that's kind of giving them bad vibes. And it's also a concern that moving into this debt cycle is creating new risk that these companies aren't going to be able to handle their obligations. So that's the most concise way I would say what's happening at this moment. Now, Austin, the market this morning, we're filming, who knows how it will close, but the NASDAQ had initially opened down 1.7%, and I'm refreshing, it's down 0.57. That's still not in the green, but these kind of herding behaviors and ideas can change very quickly. So I think, if investors think April, it felt like the market was going to go down forever, and all of a sudden there's a quick change in narrative. The same can be true at moments like today. So we'll see if that happens.
And it would no disrespect to Dr. Burry, who is an unbelievably talented and sharp investor, but he's been pretty perma bearish ever since he made his mega win in The Big Short. He shorted Tesla famously and got torched on that. He said to short the market, I think it was 2 years ago, and the market's been ripping since then. He's obviously got good reasons to believe what he believes here, but simply because he called one crash doesn't mean that he's going to call this one. And my understanding is he actually already has closed out a short position on Palantir, which we talked about earlier, and he actually is closing down Scion Asset Management, which is his firm, and returning capital to shareholders. So that it's an interesting data point, but I would encourage our listeners not to hang too much on it. Burry has been calling for a lot of crashes for a long time now. Hey, let's get back to company-specific conversation here. We do want to keep this crisp. We talked a lot about the markets and the jitters and the fears. But at the end of the day, we invest in companies, right? We don't invest in vibes and trends and sentiment. We invest in operators. So let's look, and we're now out on the other side of earnings season. Again, shout out to you and the team for some fantastic live earnings coverage. If anybody wants to see what we think about these companies in real time during earnings, go to 247wallstreet.com. We have fantastic live coverage led by you and many of our analysts. Let's talk about Amazon. Surprising on the upside on earnings. The big story here has been that AWS was the cloud juggernaut, and because they were so big and so successful doing what they'd done in the past, they were slow to transition to AI. They weren't infrastructured well for AI. They were focused on very much being like what they do on retail for cloud, which is being a low-cost, reliable provider. They famously were one of the few companies to cut their own pricing proactively to win market share, but that didn't translate well as you now need to build out AI stacks for cloud. And it seems like Amazon got the message because now AWS is back to greater than 20% growth in the most recent earnings. What is driving that? Did it just take them a while? I mean, what's behind this here? The Empire Strikes Back. They figured it out.
They are fighting back. And, Austin, I think partially this puts a finer point on, as much as the market is selling off right now, we are going to have this growth cycle in 2026 that you look at the capacity coming online and you're able to back in these figures. And there was a high probability Amazon was going to see an acceleration, and that's because of the overall market. It's because of their relationship with the customer they have with Anthropic. But one of the questions we're going to be looking at right now,
customer and investment, right? There's some they also are a major investor in Anthropic.
Yep, and Google's a major investor. So
right.
The big tech companies all have their kind of little vassals.
Right.
But it is interesting. I was looking at data from Semi-Analysis, which I've name checked here plenty of times. Great researcher. They have Microsoft into the Q4 of this year in cloud computing at 54% growth rates. To put that in perspective, mid last year, I think it was 33%. They've got Amazon up into, mid 20% growth rates. So we are in this kind of cycle right now where there's, for as much as people say, oh, AI stocks have these out of control valuations, there's actually heavy discounting of growth into future years. And there is fear headed into what's probably going to be a year whose growth is so far above forecasts that existed 6 months ago. It's unbelievable. So we have this dichotomy, right? And you asked earlier about what opportunities I'm looking at today. It is, I'm going to go look at Stargate next to Abilene, Texas. It is the first of this massive wave of larger than gigawatt data centers. There's a whole list I could go through. I have a list of them. And these data centers have entirely new needs around power demand, around how they handle things like liquid cooling, how basically everything is shifting, Austin, right? And, Satya Nadella was recently on a podcast with Dwarkesh, which is a large AI podcast listened to a lot of people. And Satya had said basically the reason they had backed off last year, they were too afraid of getting stuck with too much capacity from one generation, because every generation is going to change so much from the last. Every time you build a new generation, it has entirely new needs around this NVIDIA roadmap. And I believe right now we are potentially getting a really golden opportunity in that we are having this massive build out that's going on today of these data centers with new needs. And there are names getting sold off that have the most, sterling opportunities headed forward. So I know it's going to sound insane. I know people are listening to this like, how is he excited at a moment like today? I am very excited because I see these companies, I see the growth. It's all shovels in ground. And if the companies who are most aligned with are selling off, there's going to be a lot of money to be made. So this is what I'm talking about, the indiscriminate selling versus is it purely rational? I see a lot of indiscriminate. And I think people are really underestimating, Amazon's earnings are a sign of what's to come. Oh my God, I just hit a lamp here. Amazon's earnings are a sign of the growth rates we're about to see. And that's where you can see the narrative flip, where it's yes, there might be some increasing risk in a lot of these neocloud companies, but the story is the massive hyperscalers that are still 80%. And the growth rates they're about to put up this year appear to be prodigious, well above expectations.
One of the sort of indiscriminate sell-offs that I'm seeing is in interconnects, and the analogy that I'll draw in my mind, or maybe an analogy that's useful for investors to conceptualize this, is there's a transition here in technology types, right? And you've talked about this. We're transitioning from copper to light in terms of data transmission in the as you build out these data centers. And I know it's not a perfect analogy, but if you want to understand what this could look like, imagine the transition from internal combustion engines to EVs a little bit, right? It's this new technology. It takes a while to get this thing ramped. But if you had bought Tesla 10 years ago, you're really happy, right? If you had bought the leader in this new technology, you did great. But all along the way, there were sort of doubters, and every sell-off looked like the technology was never going to make it. It was going to fail. It's not a perfect analogy, but I'm seeing a lot of the interconnect companies getting completely crushed this year. Can you talk about some, and you have some in your portfolio, right? You've made recommendations here. Can you talk a little bit about what you're seeing in that subsector? Because that feels to me like a prime build out, picks and shovels play. Not only are we building data centers that are 10 times or 100 times larger and more powerful than ever in the past, we're doing it with a completely new technology format to enable these things to actually be powerful. So it's these things compound on each other. These things are a multiple as large, and you can't just use the old CapEx cycles to apply to optics, right? You need to multiply it further, right? So talk to me about what you're seeing in that section of the portfolio.
Yeah, it's one of the most exciting sections of the portfolio, and it puts a very fine point on what I just talked about, that if you go back and listen to podcasts from earlier this year, I believe in April, we had an optics expert on. At the time, these stocks, because of the tariff and geopolitical fears, from recommendation points, they were generally down 30 to 50%. Now, Lumentum's up almost 200% from our recommendation point. Fabrinet's doing outstanding. Coherent's doing outstanding. Ciena, I could go on. But Austin, the key point is, in that same interview I had just name-checked, the Dwarkesh podcast, that they went to a new Microsoft data center. I believe it's named Fairwater. That one's in the Atlanta area. And Satya Nadella said, this one data center, just this one, that we're building, this project, has more optics than all of Azure had. I believe he said 2 years ago. So again, it's these transitions where investors don't give the full value on architectural roadmaps until the money is truly being delivered. Right. So if you understand how architecture is shifting, you can make a lot of money, because people were discounting that we are reaching fundamental limits where we need the volume of interconnects that between copper and between optical. The optical had to rise dramatically. We were just approaching limits. We're seeing that play out. Optics this past quarter, beautiful earnings. Lumentum, their guidance was incredible. Coherent surpassed expectations by a wide margin. Fabrinet looked fantastic. So we're seeing an incredible cycle here. And it closely, for people who are looking at some recent ideas selling off today, I mean, it closely matches what we saw here. And I am starting to build out ideas for the portfolio of concepts that I think are going to see acceleration in 2026. Just because something's selling off today doesn't mean it's necessarily a bad idea. It just means that the market has a timing mismatch with when revenues are going to accelerate. We saw it with optics. I believe we're starting to see some serious pockets of opportunity in other areas today.
Now, it's not all sunshine and rainbows. There are some pretty big losers after earnings, right? So we talked about, Amazon maybe beating to the upside. But let's look at the other side of the ledger, right? We got to keep ourselves honest here. This is why we have a portfolio. Not every stock does well. What are some of the losers that got shellacked in earnings, justified or otherwise, right? Maybe we're seeing some premature bearishness, or maybe there's actually, some real thesis cracking going on. I see, what was the one that sold off really well? Power Solutions, right? They were off close to, what, 15%? Do I have that right?
Yeah, and they're down now 36% from when we announced the recommendation. So pretty significant.
But after earnings, they were down a material amount, right?
So yeah, the day after earnings, initially it was up 7% from announcing earnings. When I looked after hours, I was down 15. I looked when the market opened, it was down 45%. Ooh. I had someone text me and say, this seems like the kind of sell-off you only see in an accounting scandal. I said, yeah, it seems like exaggeration. They said, I'm going to buy. They were up 40% by the end of the day because from the bottom it rose 40%. Right. It's still down. The thing is, Austin, I recently in the portfolio, if someone looked at that, would be like, oh, these recent buys are not very good. We've got a number of stocks down that we had made recent, buy announcements on. The reason is because we've started out with some of these areas that I see having kind of big stories in 2026, and I've been going for smaller speculative plays to get some leverage on them. So like if you are new to the portfolio, you might have seen Applied Optoelectronics, which is AAOI. We have that as a small $5,000 position. The reason we have that as a $5,000 position is because we have larger bets on Coherent. We have larger bets on Lumentum. We have larger bets on Fabrinet. If you're coming to the portfolio and only buying the most recent stuff, you're not going to get the broad exposure across ideas, right? So when you have these indiscriminate sell-offs, these small and speculative companies will often sell off the worst. So like for Power Solutions, it might be a bad recommendation. We'll need to give time to see. But the idea was I like the overall market. I didn't think this company necessarily had anything special, but they were trading at what I saw as a fairly reasonable valuation still. And they're going to have just demand by essence of the market. Now, what investors got whacked by was it's small and speculative, and the management team might not be as good as management teams who have been through this rodeo before. They issued weird guidance, and they didn't have an earnings call. And when they finally had an earnings call, they tried explaining it. It seems relatively explainable, but you're just getting a lower quality company for the promise of upside. If you want stability in that market, you are looking at a Caterpillar or a Generac, right? And we might go through and recommend those stocks later. But, I did want to talk about some of right now, if someone's looking at kind of investment ideas, if you're small and speculative, you're going to be getting hammered in this market no matter what. That's just the type of market it is. I don't necessarily think that. I think Ouster, which just got hammered with pretty good earnings, can be a very solid company, and it could be the kind of stock that's getting sold off indiscriminately, even though they have a great long-term opportunity. They're just in the wrong narrative for the market right now. So I would encourage everyone who's looking at some of these ideas that are selling off to kind of take a deep breath. Remember, if you're buying them, they are supposed to be positioned small relative to the rest of the portfolio. And know that often there's nothing that's been thesis changing on these ideas. They're just the wrong stocks for the wrong moment, right?
Volatility cuts both ways, as we say. You got to be ready to, and no portfolio has 100% winners. But
You don't want 100% winners either.
Because you're being too conservative, right? Yeah.
You're not taking enough risk. If you believe that AI is as large as it is, and you're not taking some swings that miss, you're doing it wrong. You're doing it wrong. You want losers. I know that sounds crazy, but you want losers. That's part of the game.
Well, speaking of losers, let's look at what's happening with the bond market crash. I do want to move us crisply through here, but there are some losers going on the bond side of things, which typically we don't talk about. We're very much on the equity side, but as we transition from cash flow funded to debt funded investment cycles here, bonds and debt markets will matter more. So what is going on with CoreWeave, right? Like the Neo Cloud that we discussed, I think our episode was called Into the Clouds. We discussed a little bit about CoreWeave and other Neo Clouds. So if you want some context here, go back and listen to that episode. But there are some real clouds, shall we say, around their the believability of their bond viability, and there's a belief that they will default. We're also seeing that Applied Digital is having a hard time selling debt. Talk to me about this new development, like this new factor entering this arena as debt becomes a element here.
Yeah, and we'll try and do some quick hits, but I had originally not added the Neo Clouds to the portfolio because I thought the hyperscalers were going to see outstanding growth this year. That seems to be true, so it gives you a lower risk profile. They are going to rely on debt. You know, Austin, the one warning I would have for investors, you mentioned Iron earlier, they announced these big deals with hyperscalers, and people say, well, these are great investments because there's going to be so much demand, it's going to spill over. Well, the reason the hyperscalers are often doing these deals is because they're getting such great terms. Like the terms Microsoft got for its deal with Iron were fantastic for Microsoft. And the problem is if Iron has swelling cost of debt, it's going to be really hard for them to kind of make this math work. So I think sometimes you do see the comparisons to 2021 and this kind of chase for revenue growth indiscriminate of quality is an example of that. And that's why we've stayed away from the most speculative ideas in this market. We've talked about stock like Applied Digital if investors wanted a higher risk profile, but we haven't added to the portfolio. It's a really dangerous cycle right now. And you do, if you are in this market for better or worse, you need to be watching esoteric ideas like credit default swaps because people right now are not buying what they're selling.
Let's move on to our next topic here, which is something, I forget what episode it was. We had asked a question like, what are some of the future areas where AI has a lot of potential, you know, like subsectors where AI can impact and have a lot of potential. One that I think we talked about was cybersecurity. We've also talked about defense. We've talked about robotics, and you've now made a bet there with Ouster, and there might be more to come. I am particularly interested in the both potential and risk side of AI and cybersecurity, right? Like as AI accelerates the challenges of protecting against cyber, like, you know, as AI for offense becomes a lot more potent and sophisticated, you then need AI for defense on the data security side. Let's talk about this major cyber attack that you saw out of Anthropic, because to me, I think this sort of shows it's like, you know, the two-headed side of AI and cybersecurity here, and a sector that I personally am interested to start making some more investments in.
Yeah, and again, we'll do a relatively quick hit here, but the biggest thing is Anthropic had stopped an attack that was mostly conducted by agents into national security arenas, large companies, and they believe it was kind of coordinated by the China. So I think we're going to see more of this, Austin, and it's going to be it's not just going to be individual hackers. It's going to be the apparatus of entirely confrontational often states. And this is going to be something that we're going to need to rectify with. And I think investors, one of the big projects I've been working on recently, it will be out the Motley Fool on Monday, is a big presentation on kind of the companies benefiting from this emerging rivalry between the US and China for dominance. And it begins adding to people's portfolios a lot of stocks that maybe you might not otherwise have added. So it's a really fascinating storyline. And unfortunately, it's just a preview of what's going to come in the years ahead.
Okay, well then we'll put a pin in that one. I am excited to hear your thoughts on opportunities and risks in cybersecurity as it relates to AI. And we promised a short episode, so let's get it done with one more segment here, which is AMD. I want to hear about their investor day, and shout out to the AMD CEO for just like a phenomenal renaissance of a company. I mean, I don't know what year it was that they almost went bankrupt, but if anybody wants some really fascinating history on like, what it means to be a wartime gloves off CEO, what AMD has done the last 5 and 10 years is truly remarkable, and what they've done with this company. But let's talk about the Investor Day and what you saw out of their presentation.
Yeah, pretty simple. I'll do one surprise here. I'll give a quick buy recommendation as well.
Ooh, look at that. Dropping a little spice on our short episode.
Yeah, we'll make sure to get people an idea before they leave here. AMD, they took at their Investor Day their data center total addressable market from 200 billion in 2025 to 1 trillion, greater than 1 trillion by 2030. That was enough to see a big boost in the stock. Investors expect them to stay some lower, like 750 billion. I just wanted to highlight this to say, like, once again, as much as the media coverage of the AI stocks is that they are at these valuations that are priced for perfection, inherent in most of the valuations is actually disbelief that much of this spending comes online. If that total addressable market turns out to be true, AMD, NVIDIA, Broadcom, they're all probably massive winners from here. So, you can undershoot that and still be well ahead of consensus. But the buy recommendation I would make, Austin, today, let's just put 10,000. I want to do it on Vertiv. This is the company with the best kind of singular opportunity around these massive new data centers coming up, this new architecture around the power output from the chips, and a lot of expertise into a lot of spending areas that you're seeing grow in these new data centers. So, you're seeing a lot more capacity coming online, and you're seeing a lot more kind of growth of the total addressable market to Vertiv, and it's selling off right now. It's not dramatically selling off, but it gives a temporary opportunity. So this is the kind of company that I see, maybe it's only down 10 or 15%, but it has one of the best storylines ahead of it for the next 2 to 3 years, and storylines of shovels in the ground that's only going to be kind of asymptoting ahead. So I think, again, it's non-speculative. We've talked about many of our recent recommendations being speculative. This is a non-speculative way to play it. It's a way for investors to get broad exposure, and it's something that's selling off right now. So we've got 10,000 of it in our portfolio. This is an important enough company. We should have more than that. So we're going to get up to 20,000. And in the weeks ahead, as I am actually seeing these data centers rising up from the ground, we're going to get more specialized kind of recommendations that might have a little higher risk profile. But I wanted to start with giving this one to investors today. So we will put another 10,000 Verv that will take its position to $20,000. And I believe anyone who's interested in AI investing, this is now a core holding.
Well, there you go. Sliding in a rec at the end there. I promise our listeners, Eric did not tease that before in our show notes. So I am as surprised as you, but that's what you get when you wait. When you get a little bit of a delay here, we got to bring it home with a rec. So there you go. $10,000 in Vertiv. Eric, have fun on your field trip and your great adventure. I'm very excited to see your research when you get back. I know our listeners are going to be excited to hear all the things you see in Arizona and in Abilene, and what sort of names and brands and investments you want to see in this picks and shovels play. So until then, listeners, thank you so much for your time. Please leave us a review or comment on YouTube or Spotify. We do love to hear from you. Eric, get out of here, go have fun on your adventure, and we will catch up next time.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.